All right, everyone, I'll go ahead and kick things off for today. Thanks so much for joining. I'd like to start off by just mentioning a volunteer opportunity. We sent an email out to our member base this morning, but just to recap, we're looking for volunteers to support a new student outreach initiative that aims to reach awareness of the CFA charter and investment career paths. Starting next year, we'll be facilitating virtual presentations to local colleges and universities to educate the students about the charter holder and what it means to have different career paths. So we'll be asking for volunteers to participate in this virtual presentation and discuss their own career path and how the CFA charter has helped them along the way. The time commitment is estimated to be about 1 hour, and the location will be in a virtual setting. We hope this will be a fun and easy way to engage future potential charter holders and reach students who may not have previously considered a career in investing. Please respond directly either to the email you received this morning or to Lauren Adams, who's on the board, if you have an interest in this new outreach initiative. I'll go ahead and introduce Michael, who will give our presentation today. Michael joined Macquarie's Infrastructure and Real Assets Group in 2011 and has over 26 years of experience in private equity and investment management. He is responsible for working with the firm's global asset management platforms to build partnerships with institutional investors and their advisors. Prior to his current role, he worked at William Blair and their funds placement group, as well as their investment banking division. He has an MBA from the University of Chicago and received his undergrad in econ from Brown University. I also just want to remind everyone that Jason will be moderating today's presentation. He'll be leading a discussion group shortly after Michael is done today, so be sure to stay on the call if you're interested in participating. Without further ado, I'll go ahead and hand it off to Michael.
Thank you, Ashley, and thank you everyone for being here on your lunch hour. I'll pause a couple times during these materials for questions. I know there's a system through which you'll route those, I believe, through Ashley. And we'll kind of stick those in where they make sense. And of course, Jason or anyone else on the line, please do chime in. It makes it fun. But thank you for the introduction. I'll pass through that. There we got our important legal notice as I go through here. We talked about my background. The only other thing I'd add to that is I do come from a private equity background before investment banking and asset management, but focused on private equity. And infrastructure has a bit of both, meaning it's got a bit of private equity to it. It's got a bit of real assets, real estate to it. There are operating businesses, but real assets. And so it's an interesting perspective to have kind of seen the asset class grow. It was growing before I got here a decade ago, but nonetheless, continued to grow in terms of adoption around the world and here in the U.S. Not meant to be a commercial for Macquarie, but just to kind of level set as to who we are. Myself and Max on the line as well. We're Macquarie Infrastructure and Real Assets is the alternatives arm of Macquarie, the larger Macquarie Asset Management. But if you look at kind of the history of infrastructure, Macquarie has been a part of that all along. In terms of it's been an asset and an asset class. They've been charging tolls across bridges for a long time. But as far as an investable asset class over a couple of decades, started back actually in Australia. And have kind of exported that model of institutional investing in infrastructure around the world. But again, starting in Australia, up through different parts of Asia into Europe, Canada, and frankly, the U.S. is and the Americas is the more recent market. It's not very recent, but more recent market as far as kind of adopting it as an asset class institution. And you can see some of the statistics here. We're a more broadly a real assets manager, but infrastructure is the main piece of that, and we are the largest from an assets under management perspective. So that's it for the kind of the Macquarie background. We start here, trusted by communities. These are our statistics. These are Macquarie's statistics about the assets that we manage. We'll talk, the first part of this presentation is structured around the asset class. What is it? What are the risk, kind of the underlying risk rewards, or excuse me, underlying risks inherent in it, the return characteristics. But then the second half is the numbers. So it's, just kind of looking back at some of the historical data to kind of look at how it has performed over time, how it's performed in different environments. But the one thing I point out here when we talk about this trusted by communities, infrastructure, not Macquarie, but just infrastructure more broadly is unique in that because of the types of assets that they are, you'll hear us say the word essential quite a bit. That makes them, oftentimes, kind of low elasticity of demand for those assets, hard to substitute. And those are good things when it comes to from an investment perspective, because it leads to kind of stability of an outlook of cash flows. And on the other side of it, it also means, though, that Jason and I were having a little bit of a pre-conversation here, but it also means that they are very public. And so the management of these assets is different than, I mentioned my private equity background. In many cases, not in all cases, but in many cases, it involves public stakeholders, sometimes directly in terms of actually contracting with governmental entities, but more often, because it's not usually the case, but just that the assets themselves touch the public. So an airport, a utility, those types of things clearly maybe privately owned and privately, but they will touch regulators and or the public. So just a unique set of dynamics. And when you look at how you manage those assets, there's a skill set beyond just the can I make the business run well efficiently? Do I allocate the capex and capital efficiently? But there's also a piece of this that involves working with stakeholders outside of just the financial ones. So there's a positive to that, and there's a risk to that as well. So just getting into the just quick definition, and apologize if some of this is fairly high level, but these are the broadly accepted infrastructure subsectors. I start in the green middle there because that's where most people's heads go to when they think of the asset class. They think of transportation, airports, bridges, roads, ports, et cetera. That is clearly a piece of the infrastructure structure world. And probably the second place that people think of is kind of in the midstream power and renewables area, and renewables being kind of more recent in the last decades in terms of an addition to the infrastructure asset class. We'll talk about the risk return spectrum because not everything can be defined in infrastructure by sector, because there are things that can fall into these sectors that, depending on how you define it, it depends on your perspective. But there are things that can be in the midstream space, for instance, in particular, that may not, as you think about kind of the characteristics of infrastructure, may fall outside the risk spectrum of the asset class. And again, each manager will have a different, kind of maybe focus as far as risk return. But clearly, at some point, as you're out on the risk spectrum, you may begin to lose some of those characteristics. So sectors are important, but also we need to think about, and investors need to think about, just because it's in the sector, it doesn't mean, is it actually within the infrastructure, and is it achieving what you want to achieve? Utilities up there in the upper left-hand corner, probably been doing this for a decade, and that was right around the time when I think most people, when you would talk to them about infrastructure, and that's my job, is out talking to investors, as Ashley had mentioned, about the asset class. It was right then that transport was what people had thought of, but utilities had been owned by some of the financial investors in the space, but really began to kind of come to the forefront that larger transactions, investments, but also is kind of at the core end of the asset class. And we'll talk about why that is from a risk return perspective, but ultimately it's their monopolistic characteristics essentially that put them in that space, but also there is some regulatory aspects of those businesses that are unique to utilities in particular. Off to the right on the orange there, communications and waste, those are now firmly entrenched within, if you look at most infrastructure funds, and I'm talking from a private perspective here, public infrastructure, listed infrastructure is different around the world. Some similarities, but if you look at the private funds, they will often have communications and waste in those funds. Again, not everything in communications or waste would fall within that risk return spectrum for infrastructure. We'll talk a little bit about. I will talk a little bit about that. But communications in particular has been growing as its kind of overall proportion of infrastructure investments, as it's become more and more of a essentially another essential utility that you may have to your home or business. And then waste, it's been a smaller vertical. Not everybody, if you kind of looked at all these sectors, not everyone would have waste in there. There's a very specific kind of skill set that investors will need to have to invest there. And really, it's not all waste businesses. It's the disposal of waste, whether that be through landfill or through waste to energy, so incineration and turning turbines. But those are the assets that are hard to replicate versus the collection. Collection is part of it, but really, if you think about waste, it's what is the essential asset? Where do you earn your kind of economic rents? It's from the ability to dispose of those assets. So, getting into that a little bit further here, this slide's a busy one. I know you hear people say that, but I pointed to two points on this. Off to the left here, you've heard me say essential already once. I'm surprised I haven't said it more already. What essential really, kind of think about it, what it means is that there are few substitutes for that asset. So if you think of it in the context of a utility, clearly, oftentimes they are, most often they are, actually, monopolies, and there's some ability to substitute for that asset, but nonetheless, not easily done. It doesn't mean there aren't any. If you think about about a road, for instance, or a bridge. You can drive around that toll road or that bridge. It just depends on the kind of the distance to do that. And the other essential characteristic, and investors in this asset class are often weighing these things against each other, because I talked about sectors earlier. They can be in that sector. Okay, they're in the sector. They may be capital intensive, as this is on the slide here. They may be long lived, but really, when you start to kind of look at the risk return, you're balancing that. How essential are they, and what is the elasticity for that demand? Doesn't mean they have to be completely, there are no substitutes and no elasticity. That doesn't exist. But it's along that spectrum that you can start to judge and think about how is the investor approaching this? What is their strategy? Where along that spectrum do they intend to go? There are other risks as well. We'll talk about them. You can buy these assets as they are brownfield. You can build them, take the additional risk of building them from the ground up. But if you think about the end result, asset is built, what does it do? Again, you look at how essential is it, and what is the elasticity of the demand for it. So, and you want to have a mix of risks in a diversified portfolio as you're building it.
So could I jump in there and ask a question?
Sure, please.
So we've got this thesis that we've got assets that in general have stability of cash flows, and they've got low elasticity of demand. How then, given that stability of cash flows, could you go into a bit more detail about how Macquarie leverages that asset, not just with financial leverage, but can leverage that asset to perhaps boost cash flows from this asset above what they would otherwise be in a baseline scenario?
Yeah, for sure. So, and there are, just to be clear, certain assets have more elasticity of demand than others. There's a report on here, for sure. Those types of assets are going to have GDP sensitivity. So, and this is where it goes back to that. That there's this interesting mix between there's the underlying asset that has those characteristics or will have those characteristics if you built it or you're adding to it. but they are, they are oftentimes complex operational businesses. And frankly, if you look at the return streams, in our, this isn't meant to be a Macquarie talk, but our risk return approach is, towards the lower end of that risk spectrum, but adding value. So growing cash flow, right to your point, Jason, about how do we do that? In the form, I'll use that, and we talked a little bit in the regulated utility. That your ability to charge clients goes through a regulator, as many of you know, and that's reset over time. And so you would think, well, boy, that's kind of a formulaic, this kind of set of returns, and part of that is based on your ability and to manage your stakeholder, but it's also based on your ability to efficiently and effectively run that business. So there is an operational side to that, and we'll talk, I think, actually later here about a utility that we owned. It's one of the examples we've owned and sold it up in the Northwest, Puget Energy. But so, as you own those businesses, you're buying them at a certain value, and your regulated return, again, Jason, very clearly, is often based on that capital base. So how efficient are you both at making new investments? So in the case of the example I'm using, that was decommissioning some coal, very large wind farm being built. So you're taking the underlying risk, the operational and execution risk of executing on that CapEx bill, but that you are then earning a regulated return on that. And at the same time, you have pressure to keep customers' bills within a certain range or lower them if possible. And again, you can do that through operating the business efficiently. You can do that. You can also improve the outcome of the business based on customer service efforts, et cetera. So you can take these assets which have those core underlying characteristics. I'm using a utility as an example. And you can operate them more efficiently, and you can grow them. There are certain examples here as you go along the risk spectrum, like in communications, where you buy that core, those are contracted assets with the communications providers, and then you are adding on. You're building more cell towers, for instance, or buying portfolios of cell towers. In the case of waste, the same thing. You may own the disposal asset, and you're buying and building additional collection around those businesses. So it's those are the core underlying characteristics, but there is this operational aspect to many of these assets. Now, if you get all the way down to, you've built the bridge, and it's, we've done this. You've built the bridge, and it's, a port authority that's paying you a fixed rate, and there's not much, at that point after you've built it that you can do to change cash flow. It's going to be based on either the traffic that goes over it. So you can get far down that spectrum to a point where you begin to lose some of that ability to augment cash flow, and it will just be driven by GDP growth and or the contractual terms of that. And that's where you start to see the market has segmented itself, Jason, along those lines. So a long answer to say there are some assets that start to get pushed down to the point where they're optimized. You can buy them, hold them for 30 years. You tend to start to look at kind of single-digit returns on those assets because there's just not a lot of operational efficiency that you can drive.
Well, let's talk specifically about one asset in terms of risk and operational efficiency. So airports at the moment, passenger volumes are down 60% compared to their levels of a year ago. In terms of how is that affecting cash flow? How much of the revenue stream from passenger throughput is locked in as independent of passenger numbers, and how much is contingent upon throughput?
Yeah, I mean, those are the hardest hit of all the assets, because the vast majority of depends on the asset itself. We own both commercial and in a limited basis, we own some private service airports, which actually have been performing better than your commercial airports in the current environment. So capital structure, one of the things that the whole industry is learned through this and through COVID seems to be holding up well is that leverage can be the the one of the ways that you can mess up these assets. But so in airport, cash flows are down considerably. The traffic is bounced back in a decent way, but it is mostly driven by traffic. Depending on the there may be some slotting fees and things like that you're getting on a regular basis, but that's at a highly reduced rate. The other side of it is, in airports are there is that core piece of the cash flow that comes from the traffic. So it can be based on volume. It can be based on there's just some base level of payment for keeping your gates. But the other significant portions of revenue within the airports are actually commercial and are driven by traffic. So there are the concessions around an airport, parking and inside the airport, just in terms of basically malls to some extent. Europe as well.
So has your cash flow stream from that retail, like the food and beverage and the shopping, has that cash flow? Are you at risk there, or do the tenants just pay you a fixed rent and you're not? If they stay open, you're. I
mean, it varies, but we're at risk, because it's often a combination of the two. I'm not negotiating the airport concession agreements, but so I couldn't give you very specific details, but it's a combination of the two, meaning a percentage of revenues. There can be some fixed rents, et cetera. So yeah, I mean, it is. The way to think about airports is they are driven by demand. Now the airports that we own are the ones that are most affected by COVID, or if you look back to by 9/11, they're also the most reactive in terms of rebound, typically from an economic perspective or economic activity perspective. But yeah, I mean they fall clearly within that GDP sensitive. Ports are the same, although ports have held up. They hold up. They don't have quite that same volatility.
But volumes at ports would be down substantially, wouldn't they? Because global trade is a long way down from where it was.
It is. Well, I mean, it is down. Depends on the port that you're at, and there's nuances. So what actually happens is port volumes start to consolidate within the core ports. So as you have kind of robust economic activity, you may call on ports all up and down the West Coast or all up and down the East Coast. And it depends where you're at, I guess is the point. It's more of a step change, if that makes sense. You stop calling on Seattle, or and you start coming into Los Angeles, for instance. So the ports have held up, at least. Don't want to make this an important thing, but yeah, they've held up well. So nowhere near where the airports, but yes, as volume comes down, it comes off. It's come off. Although this, I'm not our economist, but it's been more service, kind of service led, but clearly volumes are down. But you are still bringing in a decent amount of goods into the country.
And I guess the rubber hits the road when you talk about benchmarking the performance of the funds themselves. So we got a question in the chat room of what benchmark or benchmarks are you using to benchmark your fund or funds? Because we're talking infrastructure broadly, but you have many vehicles.
That's right. So it's as an industry, it's not as kind of parsed out, if you will, as there might be if you looked at real estate and you can NCREIF and others and other benchmarks. So there are consultant benchmarks, or we report to, for instance. So to give an example, Cambridge, similar to what they have in private equity, has an infrastructure. But it does include this kind of spectrum, this risk return spectrum. Now they are beginning to segregate broadly the indices kind of energy from infrastructure, but it'll span that core through kind of core plus, so it'll span a bit of the risk spectrum. But so there are benchmarks out there to look at private infrastructure. You can look at public infrastructure, but that's got noise of kind of the public markets, and it has different sector allocations versus what you can actually buy in the private markets. So they are evolving. We are 20 years into this. You do have funds in addition to the Macquarie funds and others that have it's built up and it's more robust now, and it's a pretty good people are beginning to look at those as their benchmark. If you look at it though from a portfolio, I'm out talking and answer this question for investors, a state public pension plan, their benchmarks tend to be tied still to some other some just kind of a hurdle, if you will. So some of them are just originally they were just flat, we want to hit 8%. More commonly it's inflation plus plus some number. Everyone has different approaches to it, so it's based on a hurdle rather than benchmark, if that makes sense, just because it's they're still still maturing. We're kind of in the adolescent phase, if you will, of the asset class, if that makes sense.
Yes, it does. And those pension funds that have this hurdle, call it 8%, how sophisticated are they in understanding the leverage that's involved, the financial leverage in generating those returns? Because not just because they're my clients, they're astute, they're astute investors. Frankly, as everyone went through the financial, most investors that are allocating capital go through the financial crisis, and so infrastructure, if you look at the funds that went through that period, held up, did what they were supposed to do, but they had some volatility and more, and the loss ratio, or where you would see that, came from leverage. So it came from trying to take one of those very those very core assets and still hit a 12% return, and that becomes a math equation to be able to, versus if you look back, the best performing assets were the ones that actually, to your point or question earlier, Jason, where you were able to add the operational value, drive cash flow growth over time, and not leverage. So what you've seen at the same time is you've seen funds begin to segregate themselves based on their risk return, and so therefore, and investors begin to say, I'm fine with that core asset. Maybe it's in an open-ended kind of version of the fund world, and I'll take, or I'll just the sovereign or Canadian pension plan, and I'll buy that asset with lower leverage, but I'm willing to take 7% or 8% for the long term without the leverage. So there's less leverage today on those types of assets, and they're pretty savvy about understanding, okay, I don't want to push returns with leverage because that's the one thing that I can do. Your point around airports, right? Especially if it's a GDP sensitive asset, a road, an airport, a port, you'll take less leverage. You'll take more on a utility just because you have kind of clear cash flows. So anyhow, pretty astute, and it is segregated itself. You can go further up the risk spectrum and look kind of like private equity as well. But there, it doesn't tend to be leverage that's driving returns. It tends to be risk. So you're taking commodity risk in the energy markets, for instance, or you're doing more greenfield, you're building the assets. So it's moved away from being kind of financial risk to more operational risk that people are looking at. Are you benefiting in terms of fund flows from those pension funds with like the low interest rate environment? They can't find yields in other low risk areas?
Yeah, that and diversity. So just the overall trend to, if you talk to investors, if they list the reasons that they're adding or they've added it to their portfolios, it's going to be the risk return. It's number one. It's going to be diversity number two, and then it's going to be some combination of in the past you heard inflation more, you heard yield more. To some extent, there's a kind of a social aspect to the asset class that you'll hear some of the reasons, but it's risk return and yield, and and people come at it from different directions. If you talk to investors, I cover investors here in the U.S. They tend to be coming down the risk spectrum to look at infrastructure, or they're coming sideways from real estate. If that makes sense. But if you look at Europe or in Asia, they tend to be coming up. So, the investors here tend to be targeting in that kind of core plus space of, 10 to 12% with some yield, that type of, 10 to 15%, depending on where they are in the risk spectrum, and some yield, but that's a nice to have. You have plenty of investors here that are doing kind of open-ended core as well. But if you swap that over to other markets, they tend to be coming up looking at it for yield, because the assets do have a nice, depending on where and when you buy them, do have pretty significant yield components. So yes, they're coming at it trying to find the overall move towards private, toward alternatives. You'll see in the numbers when we get there. I mean, many of you have seen the numbers. That private equity shows well, infrastructure shows well, real estate shows well. So as investors are trying to find a place to put capital, and there does seem to be a stickiness. Jason, you talked a bit about the regulators and cost of capital on those calculations. There does tend to be, feel like it's a broad statement that there is some kind of stickiness. Kind of the discount rates haven't come down to where the interest rates are. So there's some sense that there's a bit of a spread for investing in the asset class. I think we've talked a lot here about, and thank you for the question. That makes it fun. Not that it wasn't fun already. It was already fun, but nonetheless. We've talked about the risk and returns to some extent. Maybe I'll just go to the next slide to talk about the type, because I talked about sectors and we've talked about examples, and I talked about kind of the core characteristics, but it's a long spectrum. So when you're building a diversified portfolio, you're going to have some assets that have more of these types of risks. I'll talk about what they are, or less, and you're trying to mix these together so that in different economic environments, and or you can tactically, on the margins, allocate to one type of risk more than another, depending on where you think you are in the financial cycle, et cetera. So starting on the left here, I've alluded to it, talked about it a little bit. One of the risks you can take is regulation. If you buy a outright electric utility, for instance, you by definition have a monopoly. I talked about my private equity background. You never wanted to say monopoly. It wasn't. But nonetheless, in this context, they are regulated monopolies. So your risk, while there's still risk to demand, people may use more or less electricity. There's longer term trends in terms of efficiency, et cetera, that may affect demand. We've also got electric cars and things coming online, but it's how distributed power, how people get their power. So it's not, I simplify the story for here, but ultimately you have this, this fairly inelastic demand, but the risk is the regulator. You are investing capital in that business under a framework different in different places in the world, but generally, in the same kind of ballpark of, you're allowed to earn a rate of return on the capital that you invest into that business. So, the rates are determined by taking, your cost of operating, your return on those assets, some discount rate, and that's how your revenues are derived. So, that's one set of risks. You may, you kind of may diminish some of the market GDP risk in those assets, but you have to have a special skill set to work in the regulated space.
So one potential risk in that regulated area is the risk that the regulator imposes an asset write-down. So the base upon which you're earning a regulated return could be written down, and that has a significant impact on revenue. That's kind of a segue to another question we have. And so one response to that risk would be Macquarie, the owner of the asset, if it got a sense that this was a risk, might try to exercise an option to exit or enter different asset classes, depending upon where it believed the risk spectrum was. Our question is there a lockup period, a minimum ownership period for owning these assets, or or you necessarily in for the long haul, or could you turn around and sell an asset in a short space of time?
Sure. So part of that is the answer to that question is just dictated by the type of investors we are. So our funds, we've got a series of funds around the globe, are for the most part 10-year funds. So what we're trying to, and they have, so you can extend them a little bit, and we are holding we tend to answer it's part of your question, we tend to hold those assets through the end of the fund life. So kind of unlike private equity, where you might buy something in year one and do all the operational things you're going to do, you ultimately we're trying to turn that around in 6 years. Here, there's this nice combination from my perspective and our perspective, that you're going to buy that utility, you're going to work operationally to improve cash flows, invest that capex, but you're going to continue to hold that through the kind of year 9, 10. So in a normal course, we would hold those things for the period. Are we selling them in anticipation of adverse regulatory outcomes? We could, although more often we are actually trying to sell them just post a good regulatory outcome with some visibility, just because it's harder to get the next buyer to buy into, okay, we're going into a regulatory reset. Part of the way we're trying to manage the risk that you bring up is that for any of these assets, forget if it's a regulated utility, forget if it's a GDP, kind of a, let's say it was a PPP with a government somewhere in the world. Part of that risk that fundamental to that risk is the underlying dynamic of the service that you're offering. So if you're putting capex into something that doesn't need capex and then trying to pass it on to a shrinking group of utility investors, if there's pressure that's there, we're not just looking at the utility as a math equation and saying, boy, we can put this much capex in the ground, therefore we can, and we can, operate it at X, and that's part of the, that's the underwriting. But also part of that underwriting is this a growing area? Is there a need to go from, is there a will and political will? Because ultimately regulators, they may not, some of them have different forms of what the regulators look like. But what's the dynamic that would create that risk that you mentioned, that they're going to, that they're going to be trying to squeeze your asset base? Because ultimately the flip side of that is that dissuades, investment in whatever needs to be invested in, if that makes sense. So not a direct answer, yes, if we saw some long-term or medium-term, we do that with all of our assets, something that is, it's not, at least in our approach to it, we've sold things early, frankly, more because just the tailwinds had been so, in the communication space, for instance, had been pretty aggressive, and therefore we just, we've opportunistically sold things. So we can do that. Usually each fund, will do that once. It's not a rule. It just kind of tends to be what happens. But I can't think of an instance where it was regulatory. I mean, I guess in Europe we did have an asset that we owned for a long time, and it was getting a little harder and harder. But we were already at the end of the fund life. So yeah, long story to say, we are doing that, that equation when we go into the asset and as we own it. And yes, we would take action if we thought there was an opportunity to do it. That being said, it's kind of hard to, the next buyer is likely going to see, see what's going on as well. So, it's not, it may be difficult to pull off.
What's the advantage of having the fund have a finite life? Like you said, the typical fund life is 10 years.
Mm-hmm.
You're looking to exit the investments, sometime near the end of that fund life, but the assets are going to last for decades, and you do have the ability to strategically buy and sell these assets. What's the advantage of the closed and finite life fund versus just having it invest in other assets indefinitely?
Yeah, sure. I mean, there's some structural reasons that just investors like them. But I guess probably more more to the point is that there's a couple things. One is our strategy. So open end is and this is a Mike Glasgow opinion, or I mean it's a market I guess view, and open up to questions of course. But there are open-ended core. We actually have what we call a super. Anyway, we have strategies that are invested in the lower end of the risk spectrum that are outside of our kind of our flagship world. So that are this buy them, hold them. You still have to operate them, but they're more yield oriented. Lower return hurdles. And so there are assets that are more appropriate for that. In the way that that we've been talking here today, is somewhat it's not Macquarie specific, but it's a certain type of strategy specific. In that, if you are, you asked earlier, if you are trying to improve the asset, drive the cash flows, we don't underwrite multiple expansion for the most part, but you are taking an asset over a 10-year period that you are optimizing. You're taking it from a point where and it should be a lower cost of capital on the backside. So in order to capture that, to have the discipline to do that with our strategy, a closed-end fund makes sense. I mean, you could have there are real estate funds out there. I don't know that there's any in the infrastructure space where they're kind of building to core, if you will. Doesn't mean they're necessarily physically building them. You could have that strategy where they're both in one, where and some of the open-ended competitors, I think, do some of that. They'll have these kind of stable, steady assets, and they'll add a little bit of kind of risk to them to kind of build to core. But it's really just a strat. For us, it's a strategy. Our strategy, kind of hitting that inflection point, we believe it gets you to capture the best returns over that period of time. Capture that uplift of the operational efficiency, gives you the flexibility to sell. There are a series of closed-end funds, so investors can roll their capital. But different groups approach it differently.
And while we're on risks, climate change is a risk to the electricity transmission distribution networks. In particular, if we have a large transition from homes and businesses having their own solar panels and using less electricity from the grid. Yep. Do you have a sense of the likelihood that this poses a risk to investors in transmission and distribution networks?
Yeah, and I'll get over my skis at some point as far as commenting on our utility group's perspective. But I mean, there is this, I think I even jotted it in before. There is this risk, if you will, of distributed power. You put a solar panel on your roof. However you want to think about it. As batteries get better, will you store that power in your building, your facility? You're seeing it more in the corporate side than you are on the individuals, but you are seeing it. Some of them hook back into the grid to actually feed that power back into the grid. So I'm sure many or most of you kind of understand that dynamic, but nonetheless. So yes, there is this kind of distributed power question. If you talk to our utility group, it's the risk is viewed over a long period of time. So especially if you're a bondholder, for instance, in the utility space, that's where we see the question most often, frankly. So if we have investors that are equity investors, but also fixed income investors, insurance companies, et cetera, they'll oftentimes ask our utility group, we don't think that plays out over 10 years or even 15 years, 20 years. But if you start looking 25, 30 years out, how prevalent is this going to be?
Yeah, but I mean that's all true. But if it takes 20 years to get like the return on the investment, the 20 years matters a lot.
No, that's right. You can't push it all out because there's a terminal value, right? That there's a stranded asset. So what I was getting to, without any probability, because I don't get the probability around, but the viewpoint is that the actual wires to your home, maybe you could on certain things you could you can say that that's, if you've got a factory or you've got a, a distribution center or something like that, you could be completely wireless, if you will. But that there's going to be some need to maintain that. Because, and it starts to create pressure, regulatory pressure, because who's paying, because we all pay for that, right? The maintenance of that network, we all pay for it. But from a national, just you kind of think about it from a, if everybody went on to their own individual power, how do you back? We're a long ways away from that being very, very, reliable and redundant and et cetera. So, so that there is a viewpoint that you will always need that. It's not a firm view, but and therefore, yes, there will be more and more pressure around maintaining the cost of that, because as each, you got a little bit of that prisoner's dilemma, is each person comes off the grid, right? And I don't want to pay for the for the overall, there's an equity question, how are you going to get distributed power to everybody? So those questions are, yes, Andrew Chapman, who runs our group, they think about them every time they make an investment. They're thinking about them from a stakeholder management perspective, and they're there. But from a is it going to get to that where it's all distributed? I think there's not a strong view that's where we'll get to.
Yeah. So let me add a little bit to that. So the risk to the regulated entity that we are seeing play out in the owners of the Australian electricity grids,
yep,
is that a lot of sun, a lot of people putting solar panels up, and there's government incentives to do that, because the government wants people to generate more renewable energy to meet its obligations under the Paris Climate Accord. Yep. And so all those people still need to be connected to the grid, because they don't have the ability to store the solar energy at their home. Some have batteries, but they don't have the storage capacity that they need. Yep. But they need the incentive to put the solar panels up to meet those obligations. Now, there is a fixed cost to maintain the grid, and that's allocated across, like, as a fixed charge to the homeowners, plus a variable charge to meet the total cost to the asset owner. And so as people generate more and more of their own electricity, the per unit cost that they're paying to the grid owner starts to go up, because it has to be amortized over less and less volume. So then the owner of this solar panel on their roof is saying, well, wait a minute, you told me to put a solar panel up. You gave me an economic incentive to do so. I did all of that. And then the next thing you know, you allowed the owner of the regulated asset to juice up my prices to maintain the grid. So I'm paying the same anyway that I was before. Why would I do this? I'll just stay on the grid, and you haven't met the emissions reduction target now. And so the government has to decide, there has to be some sort of loss in value here to somebody. It's either got to be the consumer, or it's got to be the asset owner, or it's got to be the taxpayer, because there is, we aren't going to spend the same, we've got to charge somebody to maintain this infrastructure, but it can't be all on the consumer's back, because that will undermine the incentive to put the solar panels up. And so the risk to the owner of the infrastructure asset is the government decides it's not the consumer, because that will undermine the emissions target. It's not the taxpayer, because people vote. And so who's left is the owner of the infrastructure asset, and the government could change policy and say, well, you're just going to wear it, and that's going to decrease the value of the asset.
Yeah. I mean, that's where that regulatory, kind of the regulatory risk aspect comes to. Like you said, it's a monopoly, but the regulator can tell you can't charge, you can't charge what you thought you were going to be able to charge for that.
Yeah.
Now, you can also have, the regulator encourage the building of the, how do you get your solar power, right? So, or wind, in the case of Puget, which we built a big wind farm, and that's where the renewable, different markets, right? You're talking about Australia versus the US, kind of different dynamics, West Coast versus if you're in the center of the US, or if you're in different parts of the US, as to what the approach is going to be and how fast they're going to drive toward, because a lot of this is driven by, as you point out, by the the turning of the power source into, from a, well, down the spectrum, right? Coal to natural gas to purely green, green forms, whatever that may be. But solar, or wind for the most part, in some places geothermal. So yeah, I mean, those dynamics, it's, as I said, I simplify this, like, but this is operationally and stakeholder intense. There's these huge benefits to having this monopoly that needs to be maintained. In that case, in the case of a utility, the grid itself. But it's not riskless, and especially as you point out, as you go out over time, in a 10-year period, I could do the math. It's great. You brought it up. One of the risks is today there's a certain viewpoint on, for any of these businesses, take it out of the utility space, on where we are in any given jurisdiction, on the sustainability of that asset, the resilience and sustainability of that asset. But that's only increasing. And so when at the end of the 10-year period, that asset is, because of the long life of that asset, you need to begin to make those changes today to maximize value in 10 years, because that's, there's going to be a different environment for, let's call it a landfill, or a waste energy business, for instance. I use those as examples, but any of the businesses, you have to add that into your business plan, because even though you may only own it for 10 years, you're selling it to somebody who's going to take a 30-year cash flow, view on that asset.
Right, and I better let you get into the volatility charts. And when because that sort of leads us into these risks, and you got these volatility figures. But as you're doing that, you might want to answer. We have another question.
Please.
So the volatility and returns charts are going to lead to the question. So for a typical client, what percentage of the portfolio would you see clients investing in infrastructure funds? And is specifically saying, is this still viewed as, in quotation marks, an alternative asset? I guess alternative to listed equities and bonds, or is it just part of a whole suite of investments? And what percentage would you see allocated to that? Or is it part of, in quotation marks, an alternative asset space?
So it's part of an alternatives asset for the most part, the alternative assets space. It is either, again, depending on people's approach, it's either incremental, meaning, I've got 15% of private equity, I've got 15% of real estate, and then I add whatever that percentage is, harder to answer, but whatever that percentage is, call it 5%, 10% to infrastructure. It's either additive. You've seen some, again, in the public pension plan world, depending on how they approach it, kind of the creating of a real assets allocation, which can include, oftentimes real estate is separate, but it can include real estate. It'll have infrastructure, you might have agriculture, you might have timber, it may have some other kind of real assets, natural resources aspects to it. But infrastructure, if you kind of look at the consultant reports, et cetera, from the different plans, it tends to be its own allocation. Where does it come from? Increasingly it comes at the expense of the traditional assets, whether that be equity markets or fixed income, versus kind of when it first started, you saw people kind of squeeze it into like a real estate portfolio or squeeze it into their private equity allocation. And that to some extent dictated what kind of risk return they wanted. Does that make sense? They did it in private equity, they did it further out the risk spectrum. If they did it in real estate, they did it further down. Increasingly, it's its own allocation, might be its own, kind of, like I said, real assets allocation, but and it's, in the States, it's lower than it is in Canada, it's lower than it is in other places, but, call it in that 5 to 10% range. You'll see 3%, it also depends on the size of your plan. There's this threshold where it's got to be worth the squeeze, worth the juice. Is that the saying, where, they want to, it's got to be able to have the appropriate effects on the portfolio. So biased, more is better from the real assets manager, but and if you look at, this is a really crude, I know we're running out of time here, but a really crude kind of efficient frontier calculation, but you could do this for private. It's going to unconstrained. It's going to dictate. You do all alternative assets. But and you can kind of look at it becomes more of a practical answer. If you're doing it on your own or with a consultant as to what does that allocation look like. There's even what is it? How is it sized versus your existing real estate allocation and private equity allocation. So it tends to be kind of in more in that kind of size of the 5 to 10%. Sorry, it's kind of going on, but that's a really rough.
So maybe you can answer this question. And I'm going to give you the specific wording here because I don't know what the labels mean.
Yep.
So the specific question is, what regulatory wrappers exist around the asset class? And that follows on with, is it only 3C7 funds, or do less stringent options exist? So I'm going to say it again because I don't know what the labels mean.
And I've been doing this for a while. I'm not sure, and I don't know if there's a way to take the person off or add them on who asked that question, or Mac, if you have a sense for what.
So maybe the broader question is, are there regulatory constraints on what type of investments are available?
Yeah, there are. Yeah, I mean, yeah. So that's where I was going to go as my non-direct answer to the regulatory numbers. So yes, these are institutional. The closed-end funds are. I'm talking broadly as an industry. Are your typical LP, GP, institutional funds, different varying minimums. Call it $5 to $10 million minimums. They can go lower, they can be waived, but there is a threshold of investor, and they are institutional in however you want to define that, but also from a regulatory perspective, institutional. So they're not even above accredited investor.
I'm told that 3C7 means only qualified purchasers can invest.
Yes. So QP being the yes, I'm answering. I'm not answering for everybody, but the general answer is yes, because you have to kind of hit that threshold to be able to invest in the most of the structures.
So but why is that? I mean, is it because the complexity of the security construction? Because the assets I can buy, as a retail investor, I can buy all sorts of risky stuff. The assets themselves are not risky. Is it the complexity of the security that I'm investing in that has sort of a fair degree of financial engineering? Why is that regulatory constraint there?
Well, it's getting, so running ways, it's getting, us, our competitors are, you've seen it in private equity. It's the same dynamic and kind of history of why private equity, funds are, took a while and are still taking a while to get into the retail market. You can invest in infrastructure and listed infrastructure. It's product innovation as far as getting it into the retail market. So the funds, the GPLP structure of the funds are structured, under securities laws, et cetera, to be distributed just through those channels. So the reality is it's an evolution and a structure, a structuring, and frankly, it's there's a bit of a chicken and an egg. It's getting more philosophical as far as the demand within the retail channel for you're coming down the risk spectrum, but still within closed-end vehicles. So there's also a demand question. What demand exists for closed-end returns at a certain level versus historically it's been higher returning. When those closed-end vehicles have made their way into the retail market, they've tended to be the kind of higher return, risk return vehicles.
Yeah, I'm just surprised that we have this constraint because yes, retail investors as a whole group are attracted to investments that they see, right? They're attracted to investments in technology, in retail space. They're attracted to what's in the news at the moment. but that's not all of them. And we've got this enormous pool of baby boomers into retirement that, as we talked earlier, like they can't find yield anywhere else. So I can see like the appeal of having infrastructure being a significant portion of those retirees' portfolios if they're running their own retirement account, because it does meet that risk return profile for those investors. And if we talk about like what they can understand, that there is a fair degree of financial engineering in the product, but the asset, they understand an airport, a toll road, an electricity distribution company. I mean, the assets themselves should appeal.
Yeah. No, all I can say is we're, as an industry figuring it out. I mean, it started with, okay, ABC Canadian pension plan. You want to, and it's just kind of worked its way to. It is more than recognized that group of investors, that it should appeal and needs to have some ability to get to them. So to your point, yes, somebody who's a, you can see it, that's me personally too, right? You can see it, you can touch it, you can understand, boy, okay, I go over a bridge, I pay $8. That's easier to understand than, some software as a service, for most folks. So conceptually, but there are things that are hurdles out there. It is, as you go down that risk return spectrum and it's private, it's how do people get access to it at what kind of fee drag and those types of things are all things that kind of come into play. But your voice is taken. We go back to our product development group, and like I said, it's not lost on them as to needing to find a way to get it into different channels.
So maybe in closing, you could tell we've got lots of portfolio managers, lots of financial advisors on the call. Maybe you could just close with saying, well, if they're convinced they should have a higher allocation to infrastructure, and I know it's not meant to be an ad, but give us an ad. Like, tell us what should they. I will, although I have to be regulatory. I've got some regulatory constraints as well. So apologize to be vague. But yes, I mean, clearly Macquarie has a robust platform of infrastructure investment around the world that can be done regionally, can be done globally. I would say, just in closing, clearly if there's some interest in, this is, you can tell, hopefully you can tell that I'm passionate about it, enjoy it, but, as a firm. So even if you're coming up the stream, you've got my contact information. If you want to learn about communication, if you want to learn about, not just me, but if you want to talk more about utilities, you can always bring in, our utilities team, et cetera, just to bring you up to speed. But as far as being able to do it, you can do it with closed end, kind of shops like ours. There are both within our shops and other shops, open-ended vehicles that may appeal to your clients. There is listed, Macquarie and others do listed infrastructure, specific strategies. So I know it's a vague answer, but I just also, from a regulatory perspective, I can't be giving the here's what's in the market, but would be happy to chat. So sorry, right, that's a non-answer. It sounds, I feel like a politician, but that's kind of what I have to do in these situations. All right, people will find you later.
Exactly. Call me. That's my answer. Call me. But seriously, thank you very, very much. I know I've gone over 3 minutes. I know you guys have a conversation. Happy to take more questions, but also don't want to just keep babbling on. So it really was fun. And Jason, I appreciate the questions. This is good stuff.
All right. Well, thank you very much for your time. Someone just give me a heads up in the chat room. Like, we have post-presentation discussion, but does anyone want Michael to stay on to answer any more questions, or are you happy to just sign off or have any post-presentation discussion? They want to sign off. So thank you for your time.
All right. That's I get it, but thank you.
Go and buy an airport.
The prices are good.
Thank you. Yeah. See ya.